And another cue that investors are going to be keenly watching is that from the United States Federal Reserve. The FOMC is going to convene tomorrow, while the street, of course, is expecting the central banks to slow the pace at which it raises those interest rates. It has in the past signaled that it is not yet close to hitting that pause button to tighten monetary policy, given persistent inflationary pressures. We've seen 4 consecutive 75 bips hikes, and that has happened until now, but the December hike could be, from what we are hearing, 50 bips. Since March, the Fed has hiked rates by as much as 375 basis points. There are the central banks that are going to be in focus as well. There is the European Central Bank as well as the Bank of England, which will be meeting on the 15th of December. And of course, they'll take stock of their monetary policy action as well. Meanwhile, we're watching what's happening on Wall Street. Dow Jones rising to start the week on a higher note. Investors waiting for that meeting. Key inflation data is also expected from the US. The blue chip Dow, of course, has added 126 points at open, while S&P and NASDAQ trading in a flat range. That move comes as investors will be focused on inflation, and that's going to happen later this week. Traders, of course, looking for a sign that inflation is actually coming under control. But then there is a crude prices story as well. Brent crude right now trading at around $76 a barrel. And this even as oil futures indicate a downward trend. That slip in Brent crude prices comes even as China is loosening some of those COVID restrictions, and all those curbs on Russian oil, those have come into force too. Analysts are attributing the weakness in oil prices to slowing global economy. The question is crude headed towards $70 a barrel now? What are the chances that that will happen? Let's find out. Manish Singh is joining us, CIO at Crossbridge Capital, and Arnab is Global Market Strategist, EMEA for Invesco. Great to have you both, gentlemen. Manish, what's your sense of the inflation scenario in the US right now? Looking at these crude oil prices, what is the outlook?
Well, my expectation, as I mentioned on the last couple of calls we have discussed, is I expect the CPI to print around 7.1 or 7.2 tomorrow. As per my calculation, what I have seen, US CPI peaked in June of this year at 9.1. We are seeing it come down steadily. You will see the CPI fall more rapidly from March onwards, because that's when the big month-on-month print that we saw this year, 1.2 in Feb, and then you had 1.3 in April, if I remember correctly. Those things drop off the calculation. So those things will start playing it very quickly. I expect the CPI to hit a handle of 4, upper of 4 range by April, I should think, and which means that any rate rise from here is really going to hurt the US economy. But that doesn't mean Fed is not going to raise rates. I expect Fed to raise rates tomorrow, and that, in my opinion, is going to has a huge consequence in terms of causing a US recession in Q3 of next year. That is my big concern at the moment.
We've spoken about how this recession could hit the US, and of course the impact is going to be felt elsewhere. Arnab Das, how are investors bracing for Fed action on interest rates now? The worry is that interest rate hikes will continue longer than expected. Do you share that worry?
Yeah, look, so I think, it's clear that the inflation rate is falling, as was just said. It's also clear that the economy is slowing down. And there are some signs that the labor market is loosening, but it remains very tight. So I'm, I guess, in a little bit more of a constructive camp, thinking that there's still some chance of a softish landing. And, the tightness of the labor market suggests, although there are, in some parts of the labor market, there are signs of, people being fired and things starting to slow down, the overall labor market still remains quite tight. So I think, that part of the labor market that is resilient, where job participation, labor force participation has fallen, yet demand remains strong, is somewhat resilient to rate hikes. And so we might need a bit more of a repricing in rate expectations, probably not much more, but maybe a little bit more. And therefore, the economy will continue to slow down. If the labor market holds up, as I'm hoping and thinking it might, we might avoid a recession or have a relatively mild recession. But of course, the cloud with that silver lining would be continued tightness in monetary policy, maybe not a significant pivot after the Fed rate peaks, but maybe more of a plateau, right? An inflection point where the rate rises slow down and stop, but don't go very quickly into easing policy. So I think those are the challenges that investors have to kind of navigate here. It's a challenge to a situation where you want to gradually go from being very defensive, very short in duration, to perhaps somewhat extending risk, somewhat extending duration, but not very much, not getting over your skis, so to speak, right? Sure. Because we still have a lot of challenges to face.
And Manish, you didn't tell us exactly where you think crude oil prices are going to settle. Are they going to be volatile for now? Do you see them going down all the way to $70 a barrel anytime soon? Because the equation between crude oil prices and the dollar index, that's an important one to bear in mind.
So yeah, I mean, if the recession thing starts getting priced in, which probably is not the case for now, but you are going to see the more call of that in Q1, then of course it doesn't mean good for the oil market. And we have discussed this in the past again, is that, I mean, I don't see any shortage of oil in this world, it's not the case. I think that there's plenty of it. And all the supply side concerns that you had, those have eased, those are easing. If you look at China, I mean, they are completely coming out of zero COVID policy. In fact, one of their so they had this tracking app which was being run at the federal level that is going to stop working from midnight tomorrow. So I think that they are very much committed to coming off the zero COVID policy that they were pursuing. In the meanwhile, as I say, I think anything that Fed does from here is going to harm the US economy. The longer it keeps the rate higher is going to harm the US economy, and that doesn't bode really well for oil prices. So I would expect oil prices to be sluggish, and lower from where it is today. And Fed is going to raise rates. I mean, I think they have committed themselves to doing 50 basis point hike and maybe another 50 basis point and take it to 5%. And that really is not going to be very helpful.
Very quickly, talking about China, Arnab, another expert I was speaking to on the show was telling us how he doesn't believe anything that comes out of China. As far as the growth story is concerned, as far as the opening up after those strict lockdowns are concerned, what do you think is going to happen as far as Chinese demand goes, and how much of a bearing is that going to have on the global economy?
Well, look, I think it's clear that China has shifted gears away from the zero tolerance policy. Given that it's very difficult to contain such infectious variants as Omicron and whatever other variants may emerge that continue to be quite infectious. I think it's clear that that some of the challenges to the zero COVID policy that spread across the country have had an effect on the thinking of the president of the Politburo. So they're clearly moving in the direction of opening up. I think we should bear in mind that opening up has been a process of fits and starts in almost any major country, right? And particularly in a country where probably immunity is relatively low because lockdowns have been so extensive and so apparently successful for so long, and immunization has not been that extensive, particularly among vulnerable cohorts and the elderly, although that's picking up. There's going to be fits and starts. And so I think what the market is thinking here, rightly so, is that the reopening and whatever increase in mobility and demand for energy, and including oil, comes from China, that's probably not going to be enough to fully offset the global slowdown. Sure. Plus, you do have whatever effect is coming through from this G7 cap on the price of Russian oil.
That's right.
It's unclear how that's going to work, but it is clear that on December 5th, when that came into effect, the price of oil fell a bit.
Yes, but that was a temporary one. And of course, many experts are talking about how this may not have as deep an impact. But we'll have to wait and watch exactly what that part of it does as well. Also, we are watching what kind of interest rate action we are going to get out of the European Central Bank and the Bank of England with the tightening of their monetary policies. But that's for later. Thank you very much, both Manish and Arnab, for joining us on this edition of India Tonight. Great to have you with us.